When we went there, it was a good opportunity to meet not only Daniel and Johan, but all their team, Anatari, Mona, and it was a very good experience. We were able to visit a few subsidiaries.
I know that you guys met at David Nyland and hello guys and welcome back to the Value Hunt podcast. Today I'm so happy to be here with Carlos, our esteemed guest, and you may know him either from Twitter or because of his fund. And he's a pretty interesting guy, to be honest, especially uh, uh, since he's from Spain, and so yeah, it's pretty different background, and we'll dive into it in our conversation, I hope. I don't know, Carlos, do you have anything to add to my short introduction?
Hello, David. First of all, thanks so much for the invitation. A pleasure to be here at your podcast, and yeah, really excited to share our views about the financial markets, the value investing way of doing things, and happy to discuss a few positions because I think we share a few of them, and some of them are quite uh, popular in Twitter nowadays. So yeah, really excited for this conversation.
Great, sounds cool. Yeah, I actually think it will be an interesting conversation, so let's see how it goes. So often my first question is to ask actually uh, who is my guest, and so who is Carlos? Could you explain a bit of your background, however you prefer to describe yourself? Yeah.
Sure, sure, sure. So I'm based in Madrid. I'm Spanish national. I studied business administration at college. I was not particularly interested in finance by that time. Actually, it was um, I wouldn't say luck, but it was unexpected that I later found that I really liked investing, and I learned all the value investing stuff in the more or less usual way. You don't learn it at university, but rather by discovering some of the books. No? Everybody we know about them. So yeah, when I finished college, I didn't know what to do more or less. So I started in kind of a related field. Actually, I was doing real estate valuations, and there's when I started to appreciate or enjoy the act of valuing assets. Although it was not equity, it was real estate, but it's similar. And then at that time, with one friend, actually he's my partner Pedro, who couldn't join today, we started to discover some of the value investing books. In Spain, there is a famous investor. It's called Francisco García Paramés. It's like the father, let's call it that way, of the Spanish value investing. He also wrote one book. And thanks to this guy and a few other investors in the Spanish landscape, all this value investing knowledge was spread among younger people, where we were included in that bucket. So thanks to these guys, we discover all this field, and yeah, we started to invest our own money at first while we were working. Pedro was a business consultant. I was doing valuations. Then I moved to a big four to do risk advisory, and then well, we had one friend. Actually, is the father of one of our best friends from university, and he had one kind of family office. Uh, it's called technically it's called a SICAV. It's like an investment fund,
Right.
and he was about to liquidate the fund because he was not. well, actively running it anymore. So it was all in in liquidity or fixed income. And mm, since we were already doing our own investing and were being, well, pretty successful. I mean, of course, with our own mistakes, as we were young and still inexperienced and with little track record. But he trusted us, and he said, "Okay, you know what? I mean, what could I lose in trusting you and giving you the opportunity to advise this my portfolio?" We were doing it as a part-time thing, parallel to our main jobs. We were not even paid at the beginning. We were doing it just for fun. It's true that this vehicle is actively traded, so everybody, at least from Spanish nationals, it's possible to buy shares of this fund if
Mhm.
someone wants. But the vast majority of the capital was tied to this to this person who trusted us. And since then, we shift the strategy and we turn the fund into an equity fund, long only, and well, we try to apply these value investing principles and valuation principles. We've done quite well in the last 3 4 years. And in the meanwhile, we've also been able to attract some more capital, mainly from our families and friends. So basically, the shareholder base in the fund is still familiar. I mean, we don't do an active marketing strategy. It's more word of mouth. But yeah, we've been able to amplify or spread the shareholder base. So no longer this person is the one who controls 100% of the assets under management. He's still uh, quite a big shareholder in the fund, but is no longer the only one. So yeah, this is the story, and yeah, we've been doing this for 3 years full time already, perhaps a little bit more. And super happy, Pedro and me, of being able to have this opportunity when we did not have any public track record, and we were still young, but we were even younger when we were given this tremendous opportunity. And I mean, we are living our dream. I mean, everybody would love to have this opportunity to start a fund. It's super complicated to start a fund from scratch. Uh, in Spain, there's a lot of regulation, lots of paperwork to do. You need a minimum capital requirement. So we were given with that already built, and we were, well, I mean, we consider ourselves really lucky, but we think we are taking this opportunity and trying to do things well and enjoying the ride.
Yeah, right. I was just thinking about that. Wow, it's like pretty amazing story, and I bet many young investors would kind of dream about that, and basically also having the ability to have the best of both worlds. Because at the end of the day, when you are a fund manager, you kind of have to sell your own product because you're a business, right? But in your specific situation, this person trusted you with their with his funds, and basically you could, yeah, apply your strategy without any, let's say, barriers or anyone, yeah, kind of bugging you and telling you what to do. And that's pretty nice.
Yeah,
And
that's really
that
nice.
that makes me curious about your actual investment strategy, because we all throw around these words like value investing and so on, but at the end of the day, value investing can mean a lot of different things to different people. And so I'm curious to know, what do you mean by value investing, and more specifically, what are you looking for, and maybe what aren't you looking for? What is something that, like, the companies that you discard at first glance? So
Mhm.
yeah, that would be pretty interesting to know.
Sure, David. So, I mean, first of all, exactly. I mean, we are lucky to be able to implement our philosophy or strategy without any constraints, and the main shareholder trusts us, and he does not interfere in our investing process. That's one thing. And then regarding our strategy and how we have evolved and what is the concept of value investing for us, well, um, now the concept for me for value investing has changed somewhat from my initial concept of that word. For me now, value investing is just, for me, in value investing is a proxy of fundamental investing. That's all.
Mm,
I mean, it's investing, analyzing the business. And when I mean analyzing the business, I mean all the qualitative and the quantitative stuff and the financials, but also the business strategy, the management, and all those things. For me, that's value investing. It's not buying at an optically cheap multiple. It's not buying um, growth per se in revenues. It's um, trying to understand the business and value or invest like an informed business owner or an informed institutional investor would invest. I mean, for me, that's value investing. It doesn't matter if you focus on certain KPIs such as growth or returns on capital or free cash flow conversion or buying at or trying to buy at a cheap multiple. But the main common thing for me in value investing is to focus on the fundamentals of the business. And then among that broad concept of value investing, we, particularly in Galileo, tend to focus on quality businesses. We have a bias toward mid to small capitalized companies, but we do not only invest in that. We don't restrict ourselves to the small cap spectrum. We also own a few large companies. But what we really look for is companies with good management teams, low debt. I mean, strong balance sheets and good business prospects. I mean, one of the things we are focusing the most lately is trying to find companies that have currently high returns on capital, and we believe that they have the ability to reinvest all the cash flows at equally attractive returns on capital in the future. So we focus a lot on their reinvestment rate. That means the capacity of the business to put back all the excess free cash flow into the business, either via organic growth or M&A to grow the business, and that they can reinvest back all that money at high return. So we not only focus on their current return on capital, but we try to guess or assess their sustainability of that of those high returns on capital. That's a very important aspect because, as you may know, I mean, when a business is operating in a successful way, um, competitors will enter that niche, and the theory says that margins and return on capital of that company should go down, and even growth should decelerate. So we try to identify companies that will be able to maintain, at least with a reasonable degree of confidence, that they will be able to maintain those high returns.
right.
That's that that would be our key focus right now in our strategy.
Yeah, I was smiling before because the way we actually connected was because I think you posted something on Twitter about tech. No, it was actually your letter to shareholders or
Yes.
something about returns on reinvested capital of Teqnion, and I read it. And I yeah, I reached out to you to see to actually tell you our, let's say, estimations were pretty close, and that was funny. I mean,
Yeah.
I hope we're right and not just both wrong. Uh, but yeah, that's I find it like a very powerful concept, and basically that's also how you can really assess the value compounding rate of that company. And that makes me also curious about the way you approach valuation, because at the end of the day, when you it's really hard to get the best of both worlds. So like a really cheap company that is really high quality too, and so most of the times we don't get those opportunities, and we have to buy companies at a fair price or maybe even at a small premium to their intrinsic value or the estimation of intrinsic value. And so, how do you think about valuation, and what do you think are the biggest misconceptions in the, let's say, in the common, like in the wisdom of the crowds about the topic of valuation? Because as you mentioned before, you can look at something and it can optically look really cheap, but then it's not a good business and you can lose money on it. So a low multiple isn't enough, right? So yeah, you could maybe expand on that.
Yeah, I mean, of course, it isn't enough, as you've just said. I mean, it isn't enough. It's perhaps the icing on the cake in an investment thesis. Mm, but things that look cheap optically, you have to think about that. I mean, usually the market is not growing. Markets are pretty efficient, although they create some temporary inefficiencies. But you have to think that if you see something trading very cheap, it's likely that there's a good reason for it. Of course, we like to buy as cheap as possible. That's an obvious thing, and valuation matters, especially in the short term. It's a factor of that contributes to return. So buying the cheaper, it's better. I mean, of course, but it's not the only thing. I mean, an investment thesis that it's only based on this is trading at 5 times earnings and it should go rate to 10 times earnings. It's by far not complete.
Right.
Um, and we've had bad experiences. I mean, buying things that were growing quite fast and they were trading super cheap, and we thought, okay, this is it's an enormous opportunity, no? And then we realized the hard way we were wrong. I mean, that growth was not sustainable. It was one-off or cyclical, and it was trading cheap because a good reason. No? And we've had bad experiences with that. So although we still try to find bargains, if we cannot find them, we are comfortable with buying companies that are trading perhaps at a fair value or at a not so cheap multiple, such as Teqnion, for example, or Constellation Software. But we feel quite confident that they will be able to reinvest their cash flows at high returns in the future. And how we approach valuation is more or less the following way. We try to project reinvestment rates and incremental returns on capital for the companies. And well, we try to estimate how much they could earn in the next 3, 4, 5 years, and then compare that to the current market cap, for example, and see if it's trading at a reasonable valuation or not. So that's more or less our approach.
Right. Yeah, it's very interesting. And just a quick question. Curious to know if you make use of Excel or just make out of the envelope maths. Like how do you approach it?
We use Excel, of course. We don't try to build out super sophisticated and detailed financial models. I think, mm, I mean, I don't think they are useless, but can be mm, too time consuming. I mean, if the opportunity looks clear with a simple spreadsheet, that's a good investment. I mean, if you need to do complicated stuff to guess or assess if something is worth investing in or not, then perhaps it's not a good opportunity. But of course, we use Excel. I think it's using financial models is good to put things down on earth, and um, well, it helps you to have a proper view on the metrics. But we don't build up sophisticated financial models. Since we are um, I would say, specialized in serial acquirers. I mean, we have a bunch of them in the portfolio. That's what we do. We assess the M&A they've done in the past. We try to project how much capital they can deploy in the coming years. Try to put a multiple at which they can still buy those new companies. Estimate returns on capital in the future of for their investments, and see what they can earn in the next 3, 4, 5 years. That's
Yeah,
how we do it.
that's pretty interesting. And I've also been studying quite a lot serial acquirers. I think it's a pretty interesting model because it gives you inherently those twin engines. Let's say you have the organic growth of the businesses they acquire, and then you also have the M&A engine, which is kind of optimized as compared to other companies that maybe do less regular but bigger M&A acquisitions. And so I'm curious to know what are the biggest lessons you've learned by studying this specific business model, and what should one look out for in terms of red flags and also say good things we have to spot in these specific companies, if you want to provide examples or anything.
Yeah, sure. So first of all, you don't want to be diluted or not too much. I mean, when you're investing in serial acquirers, you're investing in a management team that is mainly in a capital allocation function. I mean, because the operating businesses, they already have their MDs who are in charge of operating their own subsidiary.
Right.
Successful serial acquirers, they generally operate in a decentralized way, where operations uh, are run out directly by each subsidiary, and management team of the mother company usually has a function of allocating capital, of reinvesting those cash flows that all the subsidiaries earn, and they have to, well, they are focused on finding attractive opportunities to deploy that capital. In serial acquirers, of course, the majority of that capital will go to M&A. So first of all, you should avoid being diluted. Good capital, that doesn't mean they you should. I mean, that doesn't mean that if they issue equity, it's automatically a red flag. I mean, good capital allocators know that when their stock is cheap, you should buy it back, and when they are trading at a not so cheap valuation or a quite expensive valuation, you could use that equity sporadically to generate to add value. Because if you are trading at 30 times and you issue a little bit of equity, and with that equity issue, you deleverage your company, and that allows you to buy niche companies with high returns on capital at 5 times earnings. I think that creates value. Of course, you don't want to see that being done in a systematical way, but rather opportunistically.
Right.
So you don't want to be diluted, but we allow, if we think it's appropriated, for some equity issues periodically and opportunistically. Another thing you should avoid are companies that have a really high pace of acquisitions.
Mm.
Companies that are buying everything at a high clip usually end up in a bad way. And if you combine that with leverage, usually it's a big red flag. Um, Successful serial acquirers usually are patient and disciplined, and they tend not to overpay for their acquisitions. They tend to be focused in the way they run their balance sheet, and they don't mind waiting for long time periods to pull the trigger if they don't see the things clear, or if they love a business but the seller is asking for a very high price. They will have the patience and to wait or go for another opportunity. So yeah, and the high clip of acquisitions combined with um, paying high valuations for the acquired companies is another big red flag. And also, another thing I would try to avoid are big deals. I mean, successful serial acquirers tend to buy small companies, small niche companies, usually unlisted. Um, and why I should avoid? Why would I avoid large deals? I mean, a company that is doing large deals, because usually when a company acquires a larger company, they will. I mean, the price paid will tend to be higher. It will be more difficult to integrate, and if that, I mean, it will increase the risk in the business. I mean, it will represent a big chunk of all the revenue mix of the company, and if things go wrong with that one, you could be in trouble. So large deals, I would avoid them, especially mm, deals of companies which are in a restructuring mode. I prefer serial acquirers to buy already successful companies that already have high margins, that they generate good free cash flow. Because in the end, as I previously said, the management team of serial acquirers are capital allocators, not operators. And if you buy a turnaround, um, the management focus from the day they buy that company will now be in trying to turn around that business. They will get involved in operations, try to improve margins, and they will lose their focus in what really matters for a serial acquirer, which is capital allocation. So if you buy good niche companies that are already operating profitably and then they are run by capable people, the capital allocation people at the top of the pyramid, they will be able to focus on where they add value, and that's doing M&A, good M&A. And also, I would focus on axial acquirers that when they acquire a company, the seller wants to be sold to that serial acquirer because of the reputation of keeping that business. For example, with Teqnion, which is one of our main positions, we are aware that many companies they were able to acquire. Teqnion was not the highest bidder, but these subsidiaries preferred to be sold to Teqnion because they knew Teqnion would take care of their baby. Let's call it that way. I mean, imagine an entrepreneur who starts a business and wants to retire, for example. I mean, that business already has many employees, has a history, and the seller doesn't generally want to sell to a private equity that may end up firing half of the employees or restructuring the company or even dividing the company into pieces, right? So um, buyers who are perceived by sellers as a trustable and reputable firm for a safe harbor for the business are companies I would focus on. Um, and I mean, there are many other nuances and aspects, but those could be said to be like the most important for us.
Yeah, that's really interesting. And actually, you recommended me a paper from REQ Capital. At first, I wasn't able to find it, but then I did find it, and it's a massive, let's say, it's basically a book about serial acquirers. And so, if anyone is curious enough to dive deep into this model, I think it's a good recommendation from Carlos. Um, Actually, now we can take the conversation in two different places of the world. One it's in Sweden with Teqnion, or we can go to Canada to Lumine. I wanted to know which one do you want to tackle first?
Whatever you prefer.
Okay, then let's go closer to Sweden. Well, basically, Teqnion is a pretty interesting company, and I guess it's pretty well known now in the investment community, at least let's say in the more quality branch of companies. And it's also curious to see how small they are still, and how much room, theoretically, obviously we don't know in practical terms what the future will look like, but theoretically they still have a long runway. And yeah, for maybe you could explain a bit of what they do, um, and how do you think about their, let's say, runway, and what could impair or jeopardize that bright future that they are set out to take and to accomplish? Because yeah, maybe in this kind of companies that everyone sees the quality, everyone sees the runway, it's better to think about how it can go wrong rather than how it can go well. Because yeah, you can just look at the numbers, great management, and yeah, that's the easy part. So yeah, maybe you could expand on those few ideas.
Sure, David. So first of all, Teqnion is what we call a serial acquirer. They don't call themselves like that. Actually, they are the best description you could do about them is like a niche or industrial niche conglomerate. Let's put it that way. But they share the same good characteristics I mentioned before. It's composed by a headquarter where, well, the management team is focused mainly on capital allocation. They have a lean corporate structure. You have Johan, which is the founder and CEO, and now you have Daniel Fang, who is the, well, M&A guy. You have other very nice people we were able to meet last year when we went to Stockholm, who are kind of subsidiary CEO mentors. These guys, they try to help the MDs of the subsidiaries in whatever they need. I mean, if they want to grow, they advise them on how they could improve growth or improve margins and things like that. And then under that headquarter level or mother level, you have all the subsidiaries they have been acquiring over the years. Um, they don't follow a specific vertical besides being niche and kind of product related, but their subsidiaries and markets are quite diverse. I mean, you have companies which operate in the healthcare sector, others in defense, others in electrification. So they are quite diversified. It's not a roll up of a specific vertical, but rather a niche acquire. A niche acquire. They do not do software or technology. They like to buy companies whose main revenue source is a physical product. And then perhaps it could have some services attached to it, but they feel comfortable with physical products in the end. Um, and yeah, I mean, they started before the great financial crisis with Johan and other co founders. They went through some difficulties during the great financial period. But well, they managed in the end to survive. Now, Teqnion is composed of around 25 subsidiaries, if I'm not mistaken. And everything changed a little bit more or less when Daniel Fang back in 2021 joined Teqnion, because we feel that since he entered, the quality of the acquired companies has increased somewhat. Because their legacy companies they acquired in the past, some could be a little bit cyclical. They are good businesses, but some of them have some real estate exposure, for example, or heavy machinery. But since Daniel joined, he has been able to close very attractive deals of super extraordinary businesses, very niche at really low valuations. So, regarding your question of risks that could impair Technion to continue this profitable growth trajectory in the future. It's all in the end about two main factors, and then we can subdivide those two big factors in more risks. But first risk is that they cannot find good reinvestment opportunities, and that risks has more ramifications, right? I mean, for example, um, how will they be able to scale up their M&A team? Because now uh, it's a group of Daniel and Johan, and that's all. And I mean, nowadays they can find four, five, six deals per year, and they still move the needle every year. But what will happen when Teqnion is already formed by 50 subsidiaries? Someday they will need to increase their M&A pace, and how will they be able to scale it? Will they keep it in a centralized way and they will build up an internal M&A team led by Daniel, for example, or will push down the M&A decisions to the subsidiaries, for example? That affects reinvestment capacity in some way. That's a risk. How will they scale up their M&A team? Now it's easy because 4 or 5 deals per year it can be done. It could be done by a small team, but um, how will they solve that problem as they grow? Another risk, this one totally related with investment opportunities, that will not be able to find interesting acquisition targets at reasonable valuations. I think that risk is quite low because now they operate only in in Sweden, in the Nordics, and a little bit of UK now and Ireland. But I think the amount of good small and medium sized niche companies in Europe is quite large. The size of companies Technion focuses are even small for private equities, so they don't find that um, many competitors, that many private equity competitors. And I mean, they are still in the Nordics, and they've done 2 or 3 deals in the UK and Ireland. I mean, they could increase their geographical presence. They could jump to United States. They could jump to Central Europe, other Nordic countries. So I think their ability to find good opportunities at good prices is there. I mean, I think that that's a low risk. I mean, they are flexible. If they see that the market is heating up in Sweden, they could jump to UK, where they are finding bargains right now. If the UK someday gets frothy, well, they could move to another market. So, in that sense, the only thing that would worry me is their ability to scale up their M&A team, and also related to reinvestment opportunities is key person risk in Daniel. I mean, what if Daniel leaves Technion, right? I mean, Johan did a good job. I mean, of course, the company would not die; it's in good hands. But the guy who could change it, or who could do exceptional things, or who is doing a great job in finding amazing subsidiaries at good prices, is Daniel. And then other risks I could see is their ability not to find opportunities, but to find opportunities that could give Technion a nice return on investment. Their hurdle rate is around 50% because they want to uh, get their money back in 5 years. So de facto, yeah, the hurdle rate is 15%. What if competition increases? What if private equity start to compete in this area of smaller niche industrial companies? Well, perhaps valuations could increase and returns could go down. But so far, I mean, private equities are not very interested in many of the subsidiaries Technion acquires. And also, as I said before, I mean, many sellers, they know what private equities sometimes do with acquired businesses, and they just break them down. They try to restructure them. increase margins, they fire people, and sellers don't generally they don't trust private equity for that, and they prefer, even at a lower multiple, they prefer to sell to trustable partners such as Teqnion or other serial acquirers in Sweden, which have good reputation.
Yeah, that's a pretty good wrap up, I guess, of what Teqnion does and the risks. Um, Actually, there was a bit of a turmoil recently with Teqnion, maybe a couple of months ago. Actually, it was on the first time we talked, exactly on that day, uh, that they announced. First, there was like some sellout of shares, which appeared in the reports, and basically it was a mess. The facts now are that uh, Johan lent shares to Daniel, and Daniel now owes money to Johan, and he has a like a big stake in Teqnion. Also, Chris Mayer now is a member of the board, or will be appointed a member of the board. So there was a some changes recently. I'm curious to know whether that, in your opinion, is just noise and short-term noise, or does it affect the long-term trajectory of the company? And if you could expand more specifically about the transaction between Johan and Daniel, because like it's pretty interesting to me how someone that is so conservative, uh, let's say in capital allocation, actually takes up so much debt, let's say, and how the relation between Daniel and Johan could be affected. Uh, Basically now they before they were just partners, and now they are partners, but Daniel owes money to Johan, and uh, I don't know if that changes anything, but I'm just doing like this devil's advocate, let's say, mindset. And so, yeah, what do you think about all this situation, and more specifically about the relationship between Daniel and Johan?
Hmm. Yeah, it's true. There's been a lot of noise lately, especially after the Q4 results. They were not good, with negative organic growth, and but it was more important, and what created all this noise was not the results itself or themselves, but rather that at the report it was disclosed that Daniel had sold a big part of his shares. So there was a lot of noise, a lot of speculation, and they didn't communicated that because apparently Daniel was not under the rules of insider trading, so he was not supposed to be forced to disclose that he had sold, but in the report it appeared. So at first, I mean, we were concerned, of course. I mean, you have bad results with an important insider selling. Then they did another press release that Daniel had doubled down and he had bought shares via a loan that Johan had made to him to buy part of his stake. And At first, we had our doubts, of course. We had our doubts, and they gave an explanation of why Daniel had sold his shares previously. It was because potential stock option program who was being more or less arranged with the main shareholder, but it didn't end up well. So he had sold shares supposedly to finance the purchase of some stock options, but then that didn't happen. So, I mean, it was a little bit messy. I think they could have done a better effort to explain things in a more clear way. I don't know what you think about that, David. But then, if you focus on the outcome, and the outcome is good for us. I mean, the outcome means now Daniel has a big stake in the company. Uh, yeah, I mean, he's kind of leveraged because he has bought the vast majority of that stake with a loan. But I mean, he's a smart guy. He knows how to search for good deals, and if he has done that, I imagine it's a good deal for him. That means, for me, from my perspective, that he's confident in Teqnion. That aligns Daniel even more with the minority shareholders. That decreases the risk of Daniel leaving Teqnion in the future. I mean, it attaches Daniel more to the company. And I mean, regarding the relationship between Daniel and Johan, I don't think that would change anything, personally speaking.
Yeah, that's really interesting. Uh, and Yeah, for me, like you said before, the biggest variable in assessing serial acquirers is actually assessing the quality of the management, because at the end of the day, you are kind of co-investing with them because they are calling the shots, and you have to trust them that they do good acquisitions and good decisions and good capital allocation. And actually, that's not that easy, because assessing people maybe some of the is maybe the hardest thing to do, uh, even when you know people, especially from from a distance. It's even harder. So I'm really curious to know what was the actual feeling when you went there and visited headquarters, I guess, and um, yeah, basically, if you could share some anecdotes about that, that experience, it would be pretty interesting, and maybe it could also add value to the audience.
Sure, sure, sure. So I totally agree with that. I mean, assessing management team is the most qualitative aspect of a due diligence and perhaps the most difficult one. Because, yeah, I mean, there are some metrics you can do and quantify. For example, their salary as percentage of their total net worth invested in the company and things like that. But there are a lot of qualitative variables, uh, even the feeling you have when you talk to them, right? So yeah, when we went there, it was a good opportunity to meet not only Daniel and Johan, but all their team, Anna Karin, Mona, and it was a very good experience. We were able to visit a few subsidiaries, Kima, which makes, well, um, kitchen tables, stainless kitchen tables, um, and yeah, basically stainless tables for the hospitality industry, which was is not the typical Teqnion company because it was kind of a turnaround story. And we also had the chance to visit Iloflex. Iloflex, they focus on developing and manufacturing electric wheelchairs for disabled people in a, well, in a cost efficient way. We were able to meet the CEO. He was a great guy, super energetic and super focused on growth and super passionate about what he was doing. He was not the founder, but he was super energetic, and we it's the kind of person what you got the feeling that this guy is incentivized, is motivated, and wants to um, be part of Eloflex for many years, right? So it was super nice experience. We were able to visit the subsidiary with other investors. Chris Mayer was there as well, and then we had the opportunity to visit the headquarters, and we had lunch with Daniel, with Johan, and with Mona and Karin, who are CEO coaches. And I mean, it was nice to meet them personally. We exited the visit with the feeling that these guys are honest, they are humble, they love what they do, they are trustable in the end. That's the feeling we got. um Anecdotes, I mean, they, for example, their headquarters, they sublease, I mean, they are yeah, actually they sublease few rooms from another company who is a tenant in an office building. So imagine, I mean, they are really focused on not wasting money in useless overheads. We had lunch at their, well, one meeting room. They just bought like some, you know, already prepared meals, and we had lunch there. Um,
Can I ask
and
what
it
you
was,
got for lunch?
yeah, we had this poke thing like avocado with quinoa and all
Ah,
these
yeah,
things,
yeah.
healthy stuff.
Sorry, just curious.
Healthy stuff. You could, we got the feeling, Pedro and me, that these guys, they don't want to spend money in useless stuff. They just want to create value for themselves and of course for us, right? So it was a super interesting opportunity, and we went back to Madrid with this reinforced idea that we were in good hands, and that especially that they were good people and they were motivated and they really loved what they do. I mean, because they always say in any interview you may have watched about them, they always tell you, we love what we do, blah blah blah. But we could really feel that.
Yeah, that's really important because you have many types of CEOs. I don't like that stereotype of yeah, all CEOs are salesy and so on. But yeah, you do get that most of the time, and I think it would be pretty odd if a CEO said, "Oh, I hate my job." Like it's yeah,
Yeah.
obviously they're going to say it's great, they love it, and so on. But it's important to actually get the feeling and look at the actual track record, and that's important. Um, that makes me wonder also about like Daniel. I know he worked at some consultancy firms, and he's passionate about investing. Wrote a book about mental models, uh, which Charlie Munger read, which is really interesting. I bet it was a crazy experience to know Charlie Munger read your book. Um, but uh, I'm curious to know, how do you think about his track record? Because at the end of the day, he's at Teqnion. Maybe this is year three, so it's a lot of time, but at the same time, it's not that much in terms of investment track record. And uh, I'm curious to know, how would you think about the quality of the underlying businesses, because it's pretty easy to get a feeling about Technion's businesses, but as they scale up, for example, Lifco or Constellation, it's literally impossible to get to know every single business. So you're forced to get, let's say, a top-down approach. And I would be curious to know, what are the main KPIs, maybe organic growth or something, that you look at to, let's say, get a general feeling about Daniel's ability to allocate capital, and also the underlying quality of the businesses, because at the end of the day, it's really nice that they are growing, but we also want them to grow in a, let's say, with quality. And yeah.
Mhm. Yeah, actually you can monitor the subsidiaries, especially the Swedish ones. There's a website called Alabolag, and you can find all the financials of the companies. I don't know if that's super accurate or not, but it should give you a pretty decent sense of what the financials of each of the subsidiaries. And what we can see since Daniel has joined Teqnion is that the acquired companies tend to have higher margins, they grow faster, they operate in less cyclical sectors, usually like niche sectors, but with a lot of tailwinds. And they've been able to buy them at low multiples. I mean, they they have achieved their hurdle rate. I'm pretty sure, even without too much growth. But I'm aware some of the companies that have recently acquired are boasting a lot of growth. So that's how we monitor Daniel. And in the end, Daniel has to buy high quality companies at low prices, and you can monitor both KPIs.
Yeah, that makes sense. And Actually, it was maybe afterwards. I just wanted to add this quick note. Afterwards, you can tell me the name of that website. I had never heard about it, and so maybe I can share it in the description or something. Um,
I can type it. I will type it for you now. And
okay. Also can see your dog in the.
yes,
Hey, dog.
say hello, everyone.
uh, okay, interesting. I'll share it in the description afterwards. Um, it was really funny to hear a couple of weeks ago. I heard this interview from Investing by the Books. It's from Redeye, which is a, let's say, a research firm that specializes in serial acquirers in Sweden, and they were interviewing Daniel, I think 2 years ago or 3 years ago, and he was talking about a big mistake of his, which was actually a 100 bagger. And I guess he had 100 bagger, but invested like 0 point something percent of his portfolio, and so yeah, it was the biggest mistake of his life in investing. Uh, and this is completely unrelated to Teqnion, but I'm curious to know what were your biggest mistakes in investing, and what did you learn from them? I think that's a pretty interesting thing to understand about you.
Well, we have a broad list of mistakes we've done in the past, and we try to not repeat them. Um, First mistake was buying companies with too much leverage. Since then, we are not now totally avoiding leverage because some kind of sectors can stand a little bit more of leverage, but we generally try to avoid a lot of leverage. We had bad experiences with a couple of companies in the past. Also, now we have to make sure we understand the business. And what do I mean by that? Is not only trying to understand how they make money, but try to understand all the potential risks the business may face in the future in terms of competition, regulation, um, uh, the consumer behavior changing towards that product, for example. So we generally had problems trying to when we try to buy, uh, let's call it like innovative business models, which are not super established. We made a few mistakes there. Business models that were not proven. We had a bunch of
Can
mistakes
you
there.
provide some examples for, just to paint a picture?
Yeah, for example, naked wines.
Oh yeah.
It's pretty popular in. Well, it used to be pretty popular, at least in Twitter. Now they are struggling, and what we thought it was a good business model, it was not that great afterwards. Luckily, we it was not a big position in our portfolio, but we exited with a big loss, and now we it's a red line we've established. I mean, just only invest in improved business models and very easily understandable business models.
Could you maybe name a few of those business models? Because I know that it's really interesting that the Nomad Partnership had like this board in their office, and they wrote down like the, I think, 3 or 4 business models they were willing to invest in. And I'm curious to know whether your list is bigger or shorter, and yeah, what are your favorite ones?
No, ours is more exclusive or red line oriented. I mean, we try to avoid complicated things.
Okay.
We prefer things that are not subject to technological disruption, for example, uh, a business model that are not super new, that are already established, things like that. Things like that.
Okay.
Rather than something specific. I mean, there are then business models we like, but more than others, but those are not red lines
Okay.
for. Okay, I mean, we like serial acquirers, we really like added value resellers, for example, razor blade model, um, co-development of one product together with a client, such as Illinois Toolworks, for example. It's a well-known example of that. There are certain business models we like, but in terms of red lines, I mean, we have to understand them. They have to be easy to understand, and they don't should not be super innovative or super sexy. I mean, we prefer like the boring stuff.
Okay, cool. Maybe you could go on with the mistakes. You mentioned it was a big list, so.
Yeah, yeah, I mean, another mistake, common source of mistakes is lack of alignment.
Mm,
Lack of alignment or a bad management team you thought it was a good one.
cool. Yeah,
Yeah, that's
that's it.
that's a classic. That's a classic. It's super difficult in the end to to assess management team, as we talked previously. Perhaps the most difficult part.
Yeah.
And yeah,
Sorry to interrupt. Like, what specific things do you check or try to research about the management that maybe are not so mainstream? Because okay, everyone is told, okay, look at the quality of the management, but how specifically do you do that? Do you go to LinkedIn and check their track record? Do you say Google them, or yeah, what do you specifically do to
yeah,
assess the quality?
we try to, yeah, I mean, to know what they've done in the past, if they've been successful or not, and also try to assess their motivations for being in that company. Yeah, we could ask previous employees, for example, what they think about their leaders. Check Glassdoor or LinkedIn as well for more references. Um, One of the things we focus more is in their capital allocation decisions they've done in the past, and what we try to model or um, how have they used the cash in the last 10 years, for example, if they've used the cash in M&A, in organic growth, if they've bought back if they've bought back shares when they had to do it, if they've been able to issue capital when it was a good opportunity, if they reduced debt when it was the good moment. So also with the financials, if you do like uh, yeah, a cash flow model, but aggregate cash flow model, you can more or less have an overview of what they've done with the cash and if it makes sense or not. And you can have a good overview of if the capital allocation decisions have been uh, good or bad. Um, so even using the financials, you can have a sense of how the capital decisions in the past they've played out. So that's a good tool we use. I mean, we just aggregate all the sources and uses of cash of each company, and you can see, I mean, um, how much percentage of all the cash flow has been used, for example, in share buybacks or in M&A or in organic growth, and that's a good tool. I don't know if many people use it, but it's very useful for us. And I mean, then you have more qualitative stuff to assess the management team. I mean, of course, classic is insider ownership and all their bonus and stock compensation structure if they do have. Um, if the insiders are selling or buying stock in the upper market recently, that's of course a good sign. Um, I mean, how have they been able to implement a nice culture in the company? That's very, very, very qualitative and difficult to assess. You can have the feeling when visiting one company. For example, with Teqnion, we had the feeling that they've been able to create a good culture. You can never be totally sure what the employees of each subsidiary think about Daniel or Johan, but we went back to Madrid comfortable, knowing or being quite sure that the culture is quite healthy there in their company, for example. But that it's true that it's pretty pretty complicated to assess. One aspect we focus as well is if the management has given any kind of guidance or goals, have they been able to achieve them? Um,
Yeah, that's a
if
good
they
one.
haven't achieved those goals, have they been humble and admitted that they didn't succeed? That's a good point. I mean, you can. We are all humans. We can make mistakes or be wrong, and we thought we were gonna grow at 20% for the next 5 years, and actually the company ended up growing at 10 or 50%. Uh, so are they? Um, I don't know how to call it in English, but do they assume? Yeah, do they assume their own mistakes? Do they
Hmm.
admit them
Hmm.
freely? That's very good. I mean, that gives you like confidence that you have a honest management team. Or on the other hand, have they, moved the goal? No, I mean, we haven't achieved that metric, but you keep pushing that metric, or you cheat or try to cheat yourself and just not acknowledging your mistakes. That's one thing we really focus on, because it's a good predictor of honesty and yeah, and how honest they can be.
Yeah, I guess that's those are all good points to take notes on. And um, yeah, I think we could jump right into Lumine. I don't know how much time left you have, but um,
Couple of minutes, but yeah, we can 5 more minutes. We could discuss for sure.
okay, sure. So maybe let's jump right into your meeting with. I don't know if it was you or your partner, but I know that you guys met um, David Nyland, and
Yes, Pedro met him via video conference. We
exactly,
didn't met
yeah, yeah.
person. Yeah,
And so uh, yeah, basically will short explain Lumine. If you want to watch like my last video, it was about it was a short pitch from my friend about Lumine, and so you can get a better feel. But basically, it's Constellation 2.0. They spin it off and they focus more on the media sector. Uh, and yeah, yeah. Now you can jump right into the insights or what you think about this company, their future outlook, and also what could break them.
yeah. Well, first of all, we were quite impressed that the CEO um, wanted to meet with us, because I mean, Constellation Universe. I mean, they are not very keen to do calls or meetings with other investors, but Lumine apparently it's wants to do things in a different way. Um, and we were surprised as well, because we are a very small fund, and you know you can we are not important for them at all.
Hmm.
So we were surprised at first that he wanted to meet, and yeah, I think it was Pedro had like half an hour conversation with the CEO, and he was quite impressed. I mean, he thought he was really energetic, and he had a lot of good deal flow or deal pipeline. Now you see they are focusing on these carve outs.
Yeah, exactly.
I think they are doing a good job. It's not a very big position for us in the fund. We have a few shares. We like them. We think the opportunity for them is huge, because they are pretty small. They can operate. I mean, they don't have any geographical restriction. That's what I want to mean. And the media sector is quite broad by definition. So I think they have a lot of opportunities. And those recent deals they are doing, they seem to be done at very good valuations, and with good prospects of profitability and growth. Um, but yeah, I mean, the cornerstone perhaps of the meeting that Pedro told me, that he thought the guy was really enthusiastic about the future prospects of Lumine.
Mm, interesting. Um, I actually my mentor works at Constellation and at one of their subsidiaries actually. And one thing that struck me as a big risk for the Constellation universe is actually um, the retention of quality
Employees.
employees. Yeah. Uh, it looks like a lot of them are leaving either for private equity because I guess they aren't paid as much. The compensation program is a lot based on the stock performance, basically. Obviously, they get a good salary, but compared to the industry or private equity, it's not that good. And many of them kind of ask themselves, yeah, we are doing all these deals for Constellation. Why can't we do it on our own? So that also creates like an internal, let's say, school of people that, yeah, they teach these people how to do M&A, and then uh, they could use that talent to do it on their own, basically. Obviously, it's harder because you don't have the structure, the capital, and so on. But still, it's a big risk. So I'm curious to know what you think about it. If you ever thought about this specific uh, risk.
I mean, of course, there's a risk there and something to monitor. I mean, I mean, I think this issue has always existed, so shouldn't be something new. But if that accelerates, it should be something to be warned and to monitor closely. Yes, but I mean, the opportunity constellation companies give to employees as they act in such a decentralized way, I don't think it could be offered by private equities. They could increase the salary, yes, bonus, but that part of feeling like an entrepreneur, I don't think the private equity will be able to offer it to employees. But of course, I mean, people like money. I mean, it's normal. They want to have a better life, pay bills, and it's something to monitor. If Constellation is not able to adapt to that, it would be something bad going on.
And have you ever thought about the internal competition for deals? Because uh, I heard it's pretty fierce. So basically, they have this database of companies, right? And they can actually say like say reservate or put a signal on the company and say I'm looking at this, and
Don't look. Okay, so other people inside Constellation, they cannot look at it.
exactly. The thing is, like when someone puts that on, maybe they don't actually like follow up on that, and so I guess they have like um, a certain time period where they can lock in those companies. But then when the company frees up, they have like 20 different people from Constellation uh, wanting that specific company, and so the management team gets like 20 different calls from the same company on the same day, and they kind of like get pissed because uh, yeah, um, it looks pretty unprofessional to get 20 different calls from the same company from different people, uh, and I guess that's one of the worst parts of being such a decentralized uh, business. But uh, have you ever looked at the internal, let's say, culture, and do you think it's a good place to work at with such fierce competition for deals? And it looks pretty much like say an investment bank where people are trying to compete with each other and so on.
Yeah, I mean, for sure, that's one of the main drawbacks of decentralization. I mean, these guys are the kings of decentralization. In some ways, they've been pioneers in implementing a decentralized model. And since it's something new, I mean, these are bad things that we are discovering with decentralization. I've never been an insider there, so I cannot actually have a perfect grasp of the actual culture that is going on inside Constellation. But I don't think the environment is such as an investment bank.
Okay. Yeah.
I wouldn't say that. I wouldn't say that. I've heard bad things, but I mean, you will always hear bad things about every company. It's uh, in the end, you have to make a decision if you want to invest in a company or not, and assess the risks and probabilities of things going really wrong. And yeah, I mean, those things we are aware of. We will monitor them, but so far, I mean, I don't think there's real problem for Constellation.
Yeah, I was just throwing those around to see to test you on yeah your answers, and I guess like I don't know if you like those kind of ones of questions, but I always like when people kind of try to destroy my ideas, and yeah, that's why I was asking. Um,
I like them. I like them. No worries.
uh, yeah, since I know that you have to jump out of the call, I will ask you last couple of questions. These are more, let's say, broad, not so related to. I mean, they are invested related, but yeah, broader questions. Uh, First of all, I'm really curious because I've been getting to know some private investors that invest their own money and so on, and they have a pretty different, let's say, day compared to someone that works at a company or invests. Yeah, it's a fund manager or something. So I'm curious to know what actually your day looks like on a typical, let's say, day where you're not talking to a kid doing a podcast.
Well, it's pretty. Every day is totally different. I mean, yeah, we. I usually start the day um, reading some news, and then I have a list of watch list of companies. Start doing well, continue my modeling or reading the 10K on our annual reports, or at least okay, we have one part of analyzing like fast to know if we discard or go further with a company. So we one part of the morning could be trying to analyze uh, KPIs or red lines that would make us discard the company or willing to go further. Then one part of the day would be reading annual reports or modeling. Also talking to other investors or other stakeholders in one company who I want to know more about. Also, sometimes for example, when we discover this REQ paper, which is quite long, I mean, I spend the whole day reading that paper. I mean, I stop whatever I'm doing and just keep reading, or even a book or another interesting paper or on some other subject. So we have a lot of flexibility. That's the good point about um, managing a small fund. We are our own boss in some way. I mean, of course, our real boss are our shareholders, but we have a lot of flexibility. Now I'm also started as a professor in a master in value investing.
Really, that's interesting.
Yes, it's called ViVE Business School. It's an online business school, and they offer a master in value investing. It's online. I think it's only it's only Spanish in Spanish, so the the students are either from Spain or Latin America so far. I don't know if we will able to create the same concept but in English. So now I joined this master. So in the afternoons also, that's why I had to join you today at 7 p.m. and not before because I had
Oh yeah.
one lesson. Yeah. And that's more or less my day now as well. Um, we have to do some meetings with prospect investors. We don't dedicate that much time to marketing, but some in a while we have to do it. Some commercial activities, and also traveling to meet some companies. We since we are small and we don't have a lot of budget, we keep our traveling costs low. But it's something we are willing to increase when our asset base increases a little bit. Because, for example, the opportunity to go to visit Teqnion and all the serial acquire event in Stockholm last year was super useful and super interesting. We were able to meet, I don't know, like 20, 25 companies in 2 3 days. It was it was amazing. And that's one aspect we want to improve. Well, not improve, but doing it more oftenly, as long as our budget allows us to do so.
Yeah, that's pretty cool. And I was wondering, like, this is completely unrelated with what I was about to ask, but uh, what is your incentive structure, and how did you design your own, let's say, incentives at
Hmm.
Galileo?
Our incentive structure is super simple. Is 1.8 percent fixed on the AUMs.
Mhm.
That's all. And why? Well, I mean, the asset manager, because we are fund advisors, and then we have the asset manager who puts all this infrastructure, back office, um, operations, all the paperwork, the daily calculation of the net asset value of the fund, all this boring stuff that we as analysts or portfolio managers, we don't want to do it. It's done by the asset manager, and the asset manager had this fee structure, and it's we cannot move it. It's 1.8% over the AUM.
Okay,
Yes. Yeah, we
that's
don't have we don't have performance fee. We don't have performance fee. We will think about in the future if we move to another asset manager, if we should change our fee structure. I think it's not perfect. I would change it, but so far we cannot do it.
yeah, it's
So
a
so
structure.
it's a problem we cannot worry nowadays because we cannot do it.
Interesting. Yeah, that's really interesting. Uh, And the last question to finish up in the best way you can is actually a thought experiment. And so, if all the investment knowledge was lost, let's say in a day, and you could only pass on to the next generation, like a single concept or yeah, a few concepts, what would they be? And yeah, maybe don't do a big list, just like one or two things.
By Teqnion. No, I'm kidding.
Yeah.
I would say alignment alignment of interests, like invest along aligned and motivated investors. Yeah,
Yeah, that's a pretty interesting thing, and obviously investing has much more nuance than that. But I always like to kind of distill as much as you can all the things we learn and so on. And I guess that's a good one to pass on.
yeah. Actually, I thought about that question, but perhaps framed in another way. I mean, if you could only ask one question to a CEO, what would that question be? And that question would be, how many shares do you have in the business?
Yeah, that's also a good one. Yeah,
If you could only ask one, of course, as you said, there are many nuances, many things are important. But if I had to choose one, would be that one.
yeah, it surely carries most of the weight. Yeah.
Yeah.
So yeah, I don't want to take much more of your time, and I had a great time talking with you, and I guess also the listeners will enjoy your insights. And always, if you want to come back or someday with your partner too, Pedro, I believe, we can. Yeah, the doors are open always. So yeah, thank you so
Thanks so
much.
much. For sure, we will want to come back. It was a real pleasure, super fun, and I hope also, yeah, the audience will like this conversation and the insights, and of course, willing to come back with Pedro next time.